Right, afternoon, everybody. We're moving on to another section of this one, fiscal policy, and we're going to look at taxation today. And taxation, this is a pretty big one as well, because it's really fundamental to our whole economic system. Is the fact that governments tax you, get the money off you, and then use that money for essential or non-essential public services. Tax is also very, very, very controversial. I'll give you some examples of such. I suppose the one thing to know about taxation, it's been around for the start of human civilization. There's always been a demand for taxes, whether it's the kings, queens, emperors. There was always a duty for you to pay tax as citizens of any country or empire that you lived in. Whether it was in Boston during the Boston Tea Party, which led to the industrial or the American Revolution, whether it was the window tax, for instance, in Dublin. Here's College Green, you can see all the windows are boarded up, so tax on windows. Whether it's taxation on buildings, so for instance, some of you are going to spend time backpacking around South America, Peru, Bolivia, and you're going to see all of these like incredible amounts of half-finished buildings. And I thought it was just slums until I realized that there's a tax been placed on buildings that are finished. So you're going to see millions of buildings all over the world that are incomplete because of tax things. Recently in Ireland, I suppose tax has been the question around tax has been at the forefront of big corporations and how much tax they pay. There's still 13 billion sitting at 13 billion sitting in account that Apple were forced to pay by the European Union to Ireland, and Ireland has refused to take it because they thought there might be knock-in consequences. 13 billion that Apple were meant to pay us, but they didn't, and the Irish government don't want it, which is quite strange. And taxation has also been, when we talk about taxation, we also talk about tax evasion and tax avoidance. The fact that if you're rich and wealthy, you can hire tax advisors and financial advisors to show you how to move your money offshore so it doesn't get taxed. Whereas us poor, disadvantaged people just don't have that luxury. So there is different tax rules for different individuals and groups of people. And it's certainly controversial. There's no doubt about that. And we will discuss tax avoidance and tax evasion later on, and we'll discuss the details with that. In essence, when we talk about economics, there's one person that you're going to come back to again and again, especially if you study this in college. This individual called Adam Smith. And Adam Smith, they call him the founder of economics, whatever that means. And in, I think it was 1798 or 1778, he wrote a book called The Wealth of Nations, which is the first real book on economics and brought in real proper economic thoughts and theories. And one thing that he brought up was this whole concept of taxation. What is taxation? What should taxation be? So he wrote this thing called the four canons of taxation, the canons of taxation, that taxation needs to be equitable, economical, there need to be certainty and convenience between all of these things. So this is the first time where someone sat down and said, okay, why are we taxing people and what's the best approach to tax? So these are four kinds of taxation. We're going to go through them now. And these are absolutely essential for you to know. This is the big question. If they ask a question on taxation, it'll always be on the canons of taxation. All right. So there's four of them. And these are the principles. Number one, and again, this is all should. I don't think you can see my quotation marks here that I'm making with my fingers. This is the principles of a fair taxation should be. Taxes should be equitable. They should be fair. They should be fair, equitable, which means people should pay in proportion to the income that they get. So in this country, for instance, there's a 20% rate, there's a 40% rate. If you're a low earner, you pay 20%, and there's also tax credits for people which is a discount on the tax you pay. You would have done this in maths, you would have done this in business, you would have done this in business studies. So someone who's on a low earner, so if you're working for a minimum wage in a retail outlet, you really won't pay any tax. You really won't pay any tax. Whereas someone who's wealthy will pay 40% tax. So it should be equitable. It should be equitable. It should be tested on your means that you have. It should also be certain. The famous phrase: "There's only two things in life that are certain: death or taxes." You have to pay tax on everything. Everyone knows you have to pay tax. So there's a certainty to it. So if you ever wonder, do I have to pay tax on this? Yeah, yes is the answer. Everything, anything you're inherited. You win the lotto and you decide to give money to your friends, that's tax you have to pay. If you win something, if you win a car, you have to pay tax on it. Whatever you do, if you earn income from shares, if you have Bitcoin and you sell it and you make loads of money, you have to pay tax on everything. Every income you earn, every good you buy, you have to pay tax on everything. everything. And the tax system is complicated, but the one thing we know is that you have to pay it. It's certain. The next thing, it should be convenient. It should be convenient, which means it should be easily paid. And it's very easy to pay taxes in Ireland because you don't really pay taxes in Ireland. They're taken out of your wages. So I don't have to bring up the revenue every year and say, how much tax do I owe you? Oh, I owe you this much, and write a check for them. It's just taken straight out of my bank, not even my bank account. It's taken straight out of my wages. So it's an immediate deduction. Same way when I walk into a shop and I buy a Mars bar, I buy a Lucozade Sport, the VAT is included in that. So any service that I buy or any product that I consume, the tax is already there. A lot of countries are different. In the US, for instance, you have to declare your own tax. You have to declare your own tax, and you have to pay your own tax in certain states. That makes it tricky, it means you need to hire an accountant to help you with your tax. It can be tricky, but it should be convenient. And again, this is the principles of a fair tax system. It should just be easy. And the last thing, it should be economical, which means it shouldn't cost the state more to charge people tax than it is what they collect. So the government should make some money out of tax. I'll give you one example. One example would that have been, or which wasn't working, was they tried to bring in water taxes a few years ago, and there was huge protests about water tax. So then they had to ask the question, well, should we bring in a water tax if people are going to refuse to pay it, and then we're going to have to get the guards involved in the criminal justice system and the prisons? It's not worth it. And if it's not worth it, it's not economical. So they're the 4 principles of tax. I think I'm going to have to break this into two videos, but that's fine. Okay, so 4 principles, you need to know all of them. So I'm going to belt through kind of the rest of them. These are principles, but they're the 4 canons, can I say? They're the 4 canons of taxation. That shouldn't say the principles. They're the 4 canons of taxation. So what else? Taxes should be perceived nor act as a disincentive. So you shouldn't be penalising people with to punish them for something they have done or haven't done. Like, it should be worth your while working. It should be worth your while working. If you have to pay 80% of your income in tax, there's no incentive for you to work. There'd be no incentive for you to create your own business if you have to pay a huge corporation tax. There'd be no incentive for millionaires to come to Ireland if they have to pay huge tax on it. Taxes should also redistribute income. And again, this could come back to our old economic system. We're kind of a mixed economic system. So the system we have is we have a welfare state. Those who can't are given assistance and allowances. And really what we're doing is we're taxing the vast amount, a lot of the tax that we get from corporation tax or from people who can't afford it, we redistribute that income back to those who need it the most. So, for instance, the pandemic unemployment scheme, or even just the straight dole. The dole is an example of redistribution of wealth. Take money from the rich, you give it to the poor, in theory. Tax rates should be consistent with and aid in the achievement of national economic policies. Like, there should be a reason why tax is 20%. There should be a reason why tax is 40%. There should be a reason why corporation tax is 12.5%. So why is corporation tax 12.5%? Because our economic objective is to attract foreign direct investment into this country to create employment. We do that through our tax system, if that makes sense. It should also influence the economy. It should stabilize. Again, this has come back to certainty. It should be something that the government know that they're getting every year. So it should be something that they can rely on. About 10, 15 years ago, when our economy crashed, like 2007, 2008, the Irish state got huge amounts of income from this thing called stamp duty. It was a tax on new homes. And at the time, back in 04, 05, 06, there was like 100,000 homes been built every year. There was huge amounts of tax being paid on that. And the government were completely reliant on that tax from new homes to fund their normal expenditure. They were reliant on one piece of tax, but it was an unsustainable tax. What happened was 2007, house prices collapsed. No one started buying houses or building houses anymore. The government had a massive hole in their finances. That's a problem. So you want to make sure the taxes are spread evenly throughout industry, throughout the economy, so that you're not, that if there is an economic crash, one of your sources of, or one of your main funding streams for your taxation is not completely cut off. And that's really what it means, stabilizing, and you don't want to be jacking up the tax to like 60 or 70% during a recession, because it'll cause not just economic instability, but also political instability and social instability as well. Like if you speak to maybe your grandparents at this stage, they'll tell you about the tax rates they had to pay back in the 80s and 70s, and it caused enormous economic and social upheaval. And there was a lot of protests, there was a lot of strikes, and it was a destabilizing thing. So the best thing you can do is just keep it certain, keep it low, keep it consistent, and keep it spread evenly. Last thing there is evasion should not be possible. It should not be possible, but it is possible. And tax evasion happens everywhere and we all are part of it. All of us are part of it. I'll talk about that more when we get to tax evasion and tax avoidance. Okay. So why does government get taxed? I think we might finish this and we'll see how much we get on. Why do governments tax? Well, they need income. They need income. We have governments in most countries around the world these days. There's no kings or queens or emperors really, governing over empires anymore. So the government that we hire or that we elect, not hire, we give them the task of running the country, and for them to give running the task for giving the country or running the country, they need money to do it. Money to pay all of us. Money to pay teachers and guards and the roads and the hospitals and everything. You know this. So it's to finance stuff. Okay, and that's really what we're talking about: finance government activities, economic objective, redistribute national wealth. It's all obviously again just for equitable, to act as an automatic stabilizer. So again, we want inflation to be low. We want interest rates to be low. We don't want people paying too much tax or too little tax. We want it to be fair and equitable. To achieve social objectives, again, this is the big kind of buzzwords from the government at the moment, is social justice and climate justice. Those who are discriminated against, or those who, if there's any social issues or health issues or anything, it's just helping those in need, really. And that's what we really mean by social objectives. You look at disadvantaged regions all over the country, all over this city, and you'll see that there's pressure for the government to intervene, to make a better life for those people who live in those areas. So that's what social objectives about. And again, you need money to do that. You need money to build a library. You need money to build a school. You need money to give people, mothers, for instance, time off maternity leave, or fathers paternity leave. It's a social thing that we want. And the last thing is our economy runs on money, so people need jobs, and the only way you're going to get jobs is if you incentivize companies to operate in a particular community or city. And for that, most companies are owned by people. People want to maximize their profit, so you need to give them incentive for them to come to Ireland. And again, for that, it's it's corporation tax, so promotion of enterprise. Okay. This is the second last slide I'll do. So there's two types of main tax. All right. There's tax we know we have to pay, and it's based upon my earnings. I'm a teacher. I'm earning about 55 to 60,000 a year. I pay less tax than someone earning 100,000 a year, but I pay more tax than someone earning 20,000 a year. So I pay tax depending on my income. So it's proportion to my income. Again, 20% of my income, 40% of my income over 33,800 euros. That's just normal income tax, and it's proportionate to my income. This is called a progressive taxation, but there's a regressive taxation that doesn't take into account how much income I have to pay. And the best example I can give here is this thing called a property tax. So I have to pay a property tax every year based upon the value of my property. Now, I might have lost my job last year. My wife might have lost her job, okay? We might be living in a house, but I might still have to pay 300 euros every year to the city council, irregardless of where I am or what I'm doing, okay? Now, I could be a millionaire living here in this house. I'm not, by the way. My wife could be a zillionaire. We'd have to pay 300 euros. And that's kind of regressive tax because it doesn't take into account how much income I earn. So progressive tax is proportional to your income. Regressive tax is not. There is some regressive taxes out there, but such is life. Okay, and the last two things is this thing called direct taxes and indirect taxes. So we'll finish with this one. Direct taxes is a direct tax that's on my income and my wealth. So how wealthy I am, my income I have. So I pay PAYE, pay capital gains, I pay USC, I pay PRS, I pay all of these different things. This is income and wealth. Whereas indirect taxes are taxed on my choices. And my choices are what I spend my money on. Okay, and the best example for that is VAT. You all buy goods, you all pay VAT. That's an indirect tax. It is not a tax directly on my income. It is a tax on the choices that I make of what I consume. So VAT, customs duties, stamp duties, the new sugar tax, the new tax on cigarettes, or the really high tax on cigarettes, or whatever the case may be. So direct taxes, indirect taxes. You need to know the difference between those two. 1450, I think we will leave it at that. Tax is really interesting, and we're going to come back to this because there's a lot to discuss. Okie dokie. Bye-bye.